A very warm welcome to everyone to our annual Adam Smith lecture. First of all, could I, just as a matter of housekeeping, ask if everyone who's joined the call other than Andy Haldane, our speaker, if you could mute yourselves, that would be really helpful. Can I also say a big thank you to Demosthenes Tambakis, our lecturer in economics, for putting all the arrangements in place for this, and a particularly strong welcome for our speaker, Andy Haldane. I'm going to ask Andy to talk. His talk will be, I imagine, something like 30 or 40 minutes, and we'll then throw things open for any questions that anyone wishes to raise. Andy, as most of you will know, is Chief Economist at the Bank of England. He's a member of the Monetary Policy Committee, and he's chair of the government's Industrial Strategy Council. It's wonderful to have you with us. Over to you to talk about the health, wealth, and happiness of nations.
Well, thank you, Chris, for that very kind introduction. And good evening, everyone. I'm sorry I can't be there in person. But we'll do the best we can virtually. That gives you the advantage actually of being able to switch off at any point you want if it gets too dull. I hope it doesn't. It's a real pleasure to be giving this Adam Smith annual lecture, and I thought I really had to theme it around an Adam Smith theme. You'll see that from the riff in the title, where I've added a bit of health and happiness to the wealth of nations. That will be a theme actually of what I want to discuss over the next 40 minutes or so, generalizing it beyond the financial to some of the kind of very important non-financial aspects of what makes a nation work, and indeed what makes a nation work less well too. Here's what I plan to say. So initially I was going to say the following, picking up on the Smith theme. I was going to say that Smith's best-known book, Wealth of Nations, 76, was the book for the 20th century. As you all know, it was a book that spoke about the benefits of self-interest, specialization, commerce, and all the above. And then I was going to bookend that by saying, actually, the book he wrote 17 years prior to that, Theory of Moral Sentiments, 1759, the centerpiece of which was much more mutual interest, reciprocity, cooperation, non-rational behavior. That was the book that would define the 21st century. The only thing wrong with that initial plan is that that's far too stylized a bifurcation of what Smith was all about. Because actually, there's loads even in Smith 76 that plays up the importance of mutuality and cooperation. And just maybe to demonstrate that, here's a couple of Smith quotes from Wealth of Nations. This is probably the best known quote in that book, one of the best known quotes in economics, actually. I'll leave you to read it for yourself. Clearly, the centerpiece of this is all matters self-interest, but how that leads to a better collective interest. Here's a second quote from the same book, from The Wealth of Nations. And this, as you'll see, speaks to a rather different set of issues. It puts center stage issues of inequality, that if you leave at least part of society behind, you cannot hope for a well-functioning nation state or economy. So even in the 76 book, there is plenty in there about mutuality of interest. Nonetheless, what I thought I'd do today is set out a bit of history, where we have come from, set out a bit of the present, where we are right now, and then do a little bit of futurology and thinking about how we might reimagine or repurpose Smith for the 21st century in the light of what has happened and in the light of what we now know. That's going to be the rough plan set out here, where we are coming from, what have been, I'm going to call the 6 pillars of success underlying the successes we've seen in our economy and in our society. Where are we now, and where do we look to in the future to rebuild a model of capitalism? I'm going to call it community capitalism to emphasize its local nature. Truth be told, the last part from me is going to be no more than a sketch of the territory. And the reason for that is because this is a model that you will be developing rather than I will be developing over the next several decades. That model is one for you to mold rather than me as a wizened old lag to be molding. But hopefully tonight I can give you 1 or 2 indications of proximate directions of travel. So let me start then by looking backwards and to tell the story of the economy, of society actually, indeed of polity to some extent as well. Over the past 250 years, it has been an extraordinary story of success since the Industrial Revolution. Each time I come back to it, I'm struck by just how extraordinary it has been. Smith legitimately was one of the intellectual forefathers of the Industrial Revolution by putting issues of commerce and specialization and market prices and market forces, the invisible hand, absolutely center stage in laying the foundations for what these days we would call a market economy. I think it's fair to say that that market economy model ushered in the fullness of time, a genuinely golden era for wealth, for health, and indeed for happiness, what I've called here the age of enlightenment. Smith himself, of course, very much one of the founding fathers, the centerpieces of the Scottish Enlightenment movement. Let me demonstrate this remarkable inflection point in our economic and societal fortunes. A few pictures. This one just looked at measures of income and wealth per head. I've marked on here 1776, the wealth of nations. And you'll see over the subsequent period, we have seen exponential growth in both of those financial metrics. GDP per head rising perhaps 15-fold, wealth per head rising perhaps 10-fold. I think those rises are impressive in their own right, but even more so for the fact that in the millennium prior to that, we'd seen pretty much no growth in either incomes per head or in wealths per head. So we had a very elongated period of essentially flatlining in living standards, punctuated by a takeoff with the dawning of the Industrial Revolution. Here's a different lens on the same issue. This looks not at income or wealth, but at measures of poverty. So left-hand side picture, we saw levels of global poverty, which at the start of the 19th century were around north of 95%, falling to a level of around 5% as we entered the new millennium. Right-hand side picture turns that into absolute numbers of people. Of course, a falling fraction of those in poverty can still be an absolutely larger number of people might be in poverty. That's the pink picture here. That was true. That was true right up to the end of the 20th century, where the numbers in poverty peaked at about 2 billion. But even on that metric, they have been tailing down since then and currently lie well below the 1 billion mark, their lowest level for several hundred years. What is true of wealth is also true of health. Here's 2 metrics that speak to that. The first is a metric of life expectancy, 1776, still marked on here. You'll see at the time that Smith was writing, average life expectancies somewhere between 35 and 40 years. That is the level at which they'd operated for many, many centuries prior to the 18th century. Like GDP per head, life expectancies had flatlined for millennia. Over the period since, we have seen very significant secular growth, roughly a doubling, more than doubling, of life expectancy over the period since, to the point where someone born today can realistically expect to live a 100-year life. And just on the right-hand side, that shows a measure of infant mortality. A declining birth rate has nonetheless been accompanied by a rising population rate, because rates of infant mortality have fallen dramatically over that period. And finally, I've covered wealth, I've covered health. Let me cover happiness. There are no measures of subjective happiness up till relatively recently, actually. You can sort of construct a proxy, as the World Bank have done, and I've shown it here. This shows a very similar pattern to wealth and health. There's a sort of different, again, indirect metric of people's well-being. On the right-hand side is a measure of the number of hours they work. At the dawn of the Industrial Revolution, Smith 1776, the average person was working close to 60 hours per week. That's now fallen, roughly halved over the period since, not quite making good on the predictions that Keynes made in the economic possibilities of our grandchildren, but nonetheless a pretty steady secular fall, which will have doubtless had some happiness benefits for those of you who are not workaholics. Different window on the same world. This looks at the average consumption. But what's the average person buying at different points in history? What was the split in particular between luxuries red and essentials blue? At the time Smith was writing, it was all blue. It was all just enough to get by. The consumption basket was essentially food and lodgings. By the start of the 20th century, roughly a third were luxuries. Today it is more like 2/3. The implications of this dramatic shift in economic fortunes, in societal fortune, haven't just been felt in economics. They've been felt in politics too. Here's one, very imperfect proxy: the extent of incidence of wars between nation states, which has also been secularly falling over that period. People like Steven Pinker have attributed some causality to those factors. And to this one, this looks at the picture by way of evolution, the political regime, comparing 1816 and 2015. The key takeaway there is the secular shift towards more democratic models of governance. Others, including Pinker, have also attributed some of that shift to the economic and societal improvements I've shown in some of those pictures. And finally, accompanying all of this, we saw a secular trend towards a more joined up world, joined up in terms of goods and services. That's the right-hand side picture. Joined up too in terms of peoples and monies as well. At least latterly, that has meant that inequalities between nation states have been falling very dramatically at least over the last 50 years or so. Next question then is why? How is it we landed on this inflection point in the fortunes of our societies, our economies, and our polities? Well, if I were to be a neoclassical economist, which I am not, as it turned out, the centerpiece of my story would be a story of innovation. That it was private innovation that in turn spawned and inspired a genuinely industrial revolution. The first industrial revolution was marked by the sort of innovations shown on this slide here. The second industrial revolution of the 19th century was spawned by these types of innovation. The third industrial revolution of the 20th century had these as its centerpieces. You all know what the centerpieces will be of the embryonic fourth industrial revolution. And that's a perfectly coherent story about how innovations in their many and various forms fueled and fired the growth of industry, of jobs, of productivity, and of living standards. And that, I think, is an important ingredient in the historical story I have told. However, that neoclassical story doesn't fully chime with all of the facts. And let me mention two that do stand out to suggest this can't be the whole story of why that inflection point was reached. I mean, one very obvious reason for that is because it's hardly as if the history of innovation began in the 18th century. Innovations came thick and fast well before that. I've given a few pictorial examples here. How is it, that Gutenberg's printing press in the 15th century didn't turn the dial on living standards, whereas the spinning jenny of the 18th century did? How do we make sense of that? And a second piece of evidence that also poses that self-same question is if we try and decompose the pattern of growth over time, in particular decomposing it between those periods when the economy's been growing, we've been in a boom, and those periods when the economy's been contracting, we've been in recession, we've been in a bust. And that's what this picture does. So for each point in history, it decomposes into the growth periods shown in blue and the shrinking periods shown in pink. And the key takeaway here is up until Smith, these two sets of periods pretty much cancelled each other out. And that's why growth on average was around zero. For every boom period, there was a pretty much equal and opposite bust period. And therein lies the story of flatlining growth on average. What changed after Smith was not, in fact, that the boom periods were boomier. The blue bars do not pick up after 1776. The real game changer, the reason why growth became positive after that point, was because, for a variety of reasons, we became better at tackling the effects of the bust period, the recessionary periods. Societies and economies found a way of coping with those periods of recession, which was much improved to the preceding several centuries. So what was it then that caused economies and societies to become much better at the avoidance of these downturn periods? Well, the story I'm going to tell is one that involves a second eye. Alongside the eye of innovation, I'm going to put a second eye, and that eye is institutions. The importance of institutions and explaining that emergence and prolongation of the era of enlightenment, the golden era of growth in health, wealth, and happiness. And by institutions, I'm going to define them in a very generic way. Certainly, I mean them to encompass all three of the sectors we ordinarily think about in an economy. That is to say, the private sector, the public sector, and the not to be forgotten, crucially, third sector or civil society. For me, all three played a crucial and mutually supporting role in delivering this extraordinary inflection point in our economic and societal fortunes. In particular, I want to talk about 6 pillars from a potentially very long list. I'll pick out 6 that I think, institutional pillars, that I think were absolutely crucial in explaining this breakthrough period for our economies and societies. They are themselves mutually dependent. They are the public limited company, the emergence of limited liability banking, the emergence of different types of measurement systems, little discussed actually in general, but I think a central feature, public education and public infrastructure, and last but by no means least, the emergence of a formal charitable third sector or civil society. Let me touch upon each of those, Chris, necessarily quite briefly, given the time. Thus, you cannot have an industrial revolution without industry. And truth be told, up until the middle of the 19th century, industry was held in check by unlimited liability. If you set up a company and that company went bust, literally all of your belongings and those of your family were on the line. That was an enormous disincentive towards people setting up and growing their businesses. The downsides were simply too great from a personal perspective, and that in turn held in check the growth of industry. A pivotal point here, given the middle of the 19th century and the emergence of limited liability in the UK and elsewhere around the world, that lessened the disincentives to starting and scaling up businesses. It lessened the disincentives to being a shareholder in those companies, and therein the foundations were laid for the emergence of the modern public limited company, demonstrated in this picture here. This just shows on the left the number of companies in the UK per 1,000 people. On the right, a measure of the equity stake in those companies relative to GDP. From this mass flourishing of companies was spawned the Industrial Revolution and the accompanying rise in jobs. Now, of course, to rise and grow, companies need financial fuel. So crucially accompanying this, we had at the same time the emergence of limited liability in banking. Prior to that, there were huge disincentives to setting up and growing banks, to make loans, because you faced the self-same personal problems of potentially unlimited liability and ending up in a debtor jail. A little bit after, non-financial companies were offered limited liability. The same was extended to banks. They took a bit longer to take it up, to be honest. It's only by the tail end of the 19th century that limited liability banking really came of age. Nonetheless, having been established, banks then kept on growing, providing ever more of that financial fuel that helped grow businesses large and small. Now, accompanying both the rise of banking and the rise of the public company was a transformation, actually, in the ways in which we kept score. There's no way anyone was going to put their equity into a company, or indeed their equity into a bank, unless they'd be pretty confident it wasn't a fraudulent pursuit. They would get their money back. And that's why at around the same time, we saw the emergence of formal measurement systems for companies in the form of company accounts to give those investors the requisite degree of confidence that their money was not being squirreled off or siphoned away. And what was true at the level of companies soon became true. But this is a picture constructing this. This is the number of accountants in England over time. So can you believe it? In 1800, there was only 11. Can you imagine? Only 11 accountants in the whole of the UK. That number's somewhat larger now, as you can see. What was true of the level of companies was also true of the level of nation states. And we have seen the gradual emergence of formal systems for measuring the success not of companies, but of nation states through the national accounts, and in particular concepts such as GDP, gross domestic product, as a way of keeping score on how well our nation states are doing. That too has seen secular growth over time, to the point where these days pretty much every country on the planet has national accounts and steers a course using measures of GDP. If you have thriving companies and thriving banks with accounts that can be verified, they also need workers with skills. So the fourth of the pillars was, of course, the emergence and development of our public education system at around the same time. In the latter half of the 19th century, the emergence of compulsory schooling in England across a rising set of age ranges, and increasingly an increasingly important role played, in addition, alongside primary and secondary, to tertiary education. It still seems to me kind of remarkable that until the 19th century in England, we only still had two universities, your place and the other place. Of course, that's been transformed over the period since, to the point where now, as we all know, fully half of young people go into tertiary education. Fifth, accompanying all of this at around the same time, we had the emergence of the state as an insurance device, obviously offering educational insurance to the masses, to a degree, welfare and health insurance as well. So this just looks at public spending as a fraction of output. Around the time the Industrial Revolution was dawning, state spending began to pick up and has followed, generally speaking, an upward trend over the period since. One aspect of that, one key aspect of that for commerce and for the Industrial Revolution, was the emergence of genuinely public infrastructure of various types, most notably road and rail. These pictures just demonstrate the growth of public, initially private, but subsequently public infrastructure, transport infrastructure over that period. Not quite a relentlessly upward path, at least for rail, courtesy of Dr. Beeching, and I will come back to that point in a second. Finally, last but in no respect least, my reading of the history books suggests that alongside this crucial role for the private sector, public limited companies, banks, measurement systems, and the rising role of the public sector, the state, in the provision of a social safety net, in the provision of public education, in the provision of public infrastructure. A crucial role alongside that was played by the third sector, by the charitable sector, by civil society, broadly defined, which had been there for centuries and centuries, but took on a much more formal role at the dawning of the Industrial Revolution, in effect repairing the rips in the social fabric that were coming about because of this wrenching technological change delivered by the Industrial Revolution, which, for all its benefits, left many casualties in terms of homelessness and poverty and the like. It was the charitable sector that glued society together, that played a crucial role in gluing society together in that situation. And this is just a picture of the rise in the number of charities over that period. If that was the story of the past, then, Chris, let me take you to the present. And the reason for doing that is because what we have seen over the most recent period is that up escalator for health, wealth, and happiness becoming, for some a travelator, in other words, not headed up, and for some a down escalator. That secular upward trend in all of those features has, for an increasing number of people, appeared to go into reverse. And accompanying that, we have seen some signs of subsidence in each of the 6 pillars that I have mentioned. For me, therein lies the reason why the market economy model is at present being asked questions of. I wouldn't put it more dramatically than that. I'd say questions are being asked whether it is delivering for as many people as it might. Let me give you some pictures that speak to that, starting with wealth. Here's one metric on incomes. It is real wages, median real wages in the US, dark blue, and in the UK, light blue. Up until 50 years ago, both lines had risen relentlessly for about 150 years. In the US, real pay of the median worker has now flatlined for the better part of half a century. In the UK, that's only been true for the past decade or so. It's a lost decade rather than a lost half century. But the key point is that for the first time since the Industrial Revolution, we have seen a period of real pay per head not picking up, but standing still. And that's even more dramatic if we look at the generational shifts we are now seeing. What this picture looks at, it takes different cohorts born at different points in history and plots the evolution of their real income over their life cycle. So if your mental model is one of rising real incomes generation by generation, you'd expect these lines to migrate in an anti-clockwise fashion over time. And that was true right up until the millennials came on the scene. Anyone born after around 1980 have seen their life cycle income paths, if anything, rotating back in the opposite direction and lying below those of earlier generations. The same would be true even more dramatically in the US. In a way, the social norm of each generation being around a third to a half better off than their predecessors, that social norm has increasingly been questioned over the last 30 or 40 years. It's more striking if you look at patterns of home ownership. This is patterns of home ownership of different generations. The millennials here are shown in the purple line. Their rate of home ownership lies not only well below that of the Generation X, that's my lot, or the baby boomers who did best of all, but even below those who were born just before the Second World War. Quite a change in fortunes. While absolute levels of poverty have continued to fall, there has been a rising incidence of in-work poverty over the most recent period. And what's true of wealth and income is also showing signs in measures of health. Two rates of male here life expectancy having flattened off over the past few years, and in a few places, I've picked out a few in the right-hand side picture, a few places around the country, some of them left behind, but by no means all of them left behind, we've actually seen male rates of life expectancy falling. This isn't anything like as dramatic as is the case in the US, where Anne Case and Angus Deaton have spoken about the rise in the deaths of despair, suicides, opioid and alcohol related deaths. The UK situation is nothing like as bad as that, but nonetheless, after a linear ascent for many hundreds of years, at the margin, there are signs among some cohorts of public health entering retreat. And if I turn finally from wealth and health to happiness, here's one diagnostic on that. It's the well-known Easterlin paradox, which is basically that money does buy you happiness, but only up to a point. Beyond a certain level of income, roughly around 25 to 30 thousand dollars per year, there are no discernible improvements in happiness from having extra amounts of money in your bank account. There are many other diagnostics on incipient unhappiness problems across parts of society, not least those deaths of despair and the epidemic in isolation and loneliness that we hear much about. And finally, to kind of complete the agony, if you like, I mentioned that between country levels of inequality had been falling over the most recent period. That has not been true of within country patterns of inequality. In general, they've been picking up over time. The right-hand side picture looks at that at a spatial level in the UK. So the spatial gaps in income in the UK between the richest and poorest regions are back now to their highest levels since the start of the 20th century. In the interest of time, I can stop quickish. Accompanying all of this, and I think not coincidentally, there are signs of, as I mentioned before, erosion in each of the 6 institutional pillars that underpinned the golden era, that underpinned the era of enlightenment. The numbers, for example, of public limited companies have halved over the last 30 years. Banking is not so obviously now catering for all of our needs, not least at a branch level. When it comes to issues of public education, much improved as they are, we have seen, if anything, metrics of social mobility going into retreat over the most recent period. The right-hand side picture here is just one diagnostic on that. It looks at the percent of children earning more than their fathers at the age of 30. That fraction was well above 50. You had a realistic expectation of earning more than your father right up until the new millennium dawned, and since then that number's headed below the 50 mark. We have seen signs, you have all witnessed, no doubt, signs of the extent to which our public infrastructure is creaking. That should be the least surprising thing in the world, given the rise in population numbers at the same time as investments in the extent of our public transport system have scarcely moved since the middle of the previous century. And finally, when it comes to our broader social infrastructure. This is to say, green spaces, museums, high streets, leisure centres, the things that make life worth living. There's an acute, this is a kind of variegated pattern of how available those crucial bits of social infrastructure are across different parts of the UK. Now, let me end on this, Chris, which is the sketchiest of sketchy models. If you bought that diagnostic of where we have been and where we are, it begs the question, which way next? How do we need to tweak the model we have, taking account and building on its successes, but doing something about the obvious fraying and fragilities we have seen of late? Many models are out there. Does this call for more state? Does this call for more market? Interestingly, some people recently have made the case for the third sector, for the third pillar, for community having a much more central role alongside market and state in gluing society back together again. For me, if I were reconceiving, reimagining, repurposing Smith for the 21st century, I would want to put equal emphasis on all three pillars: market, state, and the often forgotten third sector, and at the same time look not to demolish, but to reconstruct each of those 6 institutional pillars I've mentioned earlier on. What might that mean? It might mean repurposing, reimagining how our public companies operate, to make them more, in the modern jargon, purposeful, to seek a more plural sense of their purpose beyond pure profit maximization, a more plural set of stakeholders that includes shareholders, but equally importantly includes staff and customers and clients and creditors and communities, and of course, crucially, the environment as well. It means rethinking, reimagining, repurposing our banking system to make it somewhat more utility-like in its orientation. We can discuss that a bit more as well. It might mean reimagining and repurposing our measurement systems so that the annual accounts look beyond P&L to the broader plural set of capitals, not just financial, but human, social, environmental, that are crucial to making companies tick. Companies are not a legal construct. They are a social animal and need therefore to serve social ends. And what's true of companies is equally true of economies. GDP does well at keeping score at some things, but by no means all of the things that matter to people's lives. Some countries are taking tentative steps in the direction of keeping score by reference to other metrics, subjective metrics, including measures of happiness and well-being. Therein might be a direction for the future. When it comes to all matters education, the model we have had over the past 150 years has been fantastic. It has served us extraordinarily well, but my contention would be that the model of the past 150 years will not necessarily be fit for purpose for the next 50. Why do I say that? Because a model that focuses on nurturing academic skills in young people, I think, will need to be reoriented so that it's genuinely lifelong in its orientation and focuses as much on vocational and interpersonal skills as it does on academic ones. What's true of public education, I think, is no less true of public infrastructure. That's plainly the case with our crumbling, sometimes Victorian public infrastructures. It's even more true, I think, when it comes to the new public infrastructures, which are, to say, digital infrastructures of various types. These days, it's almost inconceivable that people could live their lives without having access to speedy broadband. And yet for many people that remains the case. For some, that's a question of availability. For others, it's a question of affordability. We have had the emergence of so-called digital poverty, and that needs to be tackled at source, in my view. And finally, as we are reconceiving of the market and the state, we should not overlook the crucial role of civil society and the third sector, and to make this a much more central piece of our lifelong learning journey, I would say. Chris, let me end here because I'm conscious I've overrun on time, for which I apologize profusely. The stakes could not be higher. Smith captured it in his Better book, his 59 book, Theory of Moral Sentiments, as such. If justice, inequality is removed, the immense fabric of society must in a moment crumble into atoms. Those are pretty evocative words. I think those words could be said of the present. Those words speak to the need for a different flavor of capitalism than that which we have had, to lean against the problems I have highlighted. That is a model that will not be for me to develop, but for you to develop. I look forward to hearing your questions and comments about how best that model might work. Chris, thanks very much.
Thank you very much indeed, Andy. That's really terrific. Very clear, a wonderful sweeping view of several hundred years, and lots of food for thought about the future.